Time for your daily dose of automotive news. Grab your coffee, tea, or whatever snack gets you going, and let's dive into what's driving the world today.
The signal didn't come from a rumor mill. It came from the biggest name on the used car block flinching in public. One sharp market shock, one messy earnings morning, and suddenly everyone's asking the same question. Is this just a wobble, or the moment the used car game quietly changes its rules? Let's be honest about why this rattled people. CarMax built its brand on being the grown-up in a chaotic business. Ruthless about data, steady with pricing, careful with underwriting. When a company like that stumbles hard enough to make ordinary buyers notice, it isn't only a shareholder story. It's a dashboard warning for anyone with a loan, a trade-in, or a lot full of metal that isn't moving. That's why this hit different. It wasn't just a number on a screen. It was a message. Pay attention. Here's the twist. The headline everyone latched onto was the massive plunge, the jaw-drop chart, the "you won't believe this" thumbnail. But the more important story lives underneath. Payment math that doesn't pencil for average households. Lenders that suddenly rediscover the word risk, and dealers who start to value cash today more than margin tomorrow. That's the undercurrent. That's the part that doesn't fit in a tweet, and that's exactly why it matters. But that wasn't the whole story. Sober walk the chain in slow motion and you see how tight everything is. Rates went up, prices resisted, trade-ins brought surprises, too many of them underwater. On paper, used cars should be the release valve for stretched budgets. In practice, the valve jammed. The monthly payment on a basic commuter suddenly feels like a second rent. Stretch it to 6 or 7 years and you're not buying a car, you're signing a lifestyle contract. Miss a beat and the bill doesn't care. And what happened next would shock a lot of buyers who thought they were playing it safe. Start with the thing nobody likes to talk about: the back door. CarMax hasn't just been buying from everyday drivers. It's been quietly absorbing more inventory from other dealers. That's a tell. Wholesale is the last resort for most lots because margins are thin and pride is involved. When more inventory flows dealer to dealer rather than dealer to customer, you're seeing stress convert into speed. Some stores would rather take a smaller guaranteed check now than bleed floor plan interest for another month while they pray for the perfect retail buyer. If you're wondering whether the market's stressed, that pipeline answers it loudly. But wait until you see how that collides with credit. Credit never looked scary on the showroom floor. It looked helpful. It looked like we can make this work. For years it did. Then the ground shifted. Approvals tightened around the edges you can't see on a glossy finance poster. The average loan still exists, but the easy loan doesn't. The buyer who used to breeze through suddenly brings paperwork to prove a world that's gotten more expensive. And when the lender hesitates, the entire deal starts breathing through a straw. Keep that in mind as we talk payments, because this is where the math gets personal. Picture the car, a straightforward sedan in the mid-20s. Nothing brag-worthy, just something to get to work, handle school runs, and survive winter. Sounds harmless, until the APR turns the key. At modest rates, the payment is annoying but doable. Push the APR into the high teens or above, and the same car transforms. The monthly jumps into "we need to reorganize the budget" territory. The total paid over the life of the loan climbs into numbers that feel unreal. You don't need a luxury badge to end up in a luxury-sized obligation. And the kicker? The car doesn't appreciate because you paid more. It still depreciates like a car. That gap between price paid and value held is where a lot of families lose sleep. Now add the worst co-pilot you can imagine: negative equity. You walk into a dealership with a trade-in. You've taken care of it. You've made your payments, but the numbers say the car is worth less than you still owe. That difference doesn't vanish. It slides into the new loan, bleeds into the new monthly, and waits for a rainy day. One repair, one job hiccup, one medical bill, and suddenly the payment you could barely carry is the one you can't. Dealers didn't invent this, and lenders didn't conspire to cause it. It's what happens when price surges meet long terms and tight budgets, and it feeds itself because each rollover makes the next one harder to escape. But the feedback loop doesn't end with buyers. Head to the auctions and you'll feel the other half of the story. Repossessions don't only hurt families, they flood the lanes and push prices into uncomfortable places. Lenders take hits on recoveries. Dealers try to time buys and get whiplash instead. Transport and reconditioning stay stubborn. And through it all, floor plan interest ticks like a metronome. That's how stress spreads. A little at the loan desk, a little at the auction, a little on the lot, and suddenly everyone is playing defense. Watch what happens to behavior when defense becomes the default. Dealers start chasing liquidity. That's why the dealer-to-big box pipeline thickens. A check today beats a maybe tomorrow. Stores that used to hold out for retail buyers decide they can't play chicken with interest anymore. They move cars out the side door, clean up the balance with the lender, and live to sell another day. None of that shows up on a happy Instagram reel, but it's the reason your local lot suddenly looks lighter and your regional CarMax looks busier. The trade isn't about profit, it's about time. Lenders respond in kind. The spreadsheets get colder. Loss allowances edge up. Risk transfers become a tool, not just a footnote. Pools get bundled and moved so balance sheets can breathe. That's how the finance system absorbs shock without making headlines. It replumbs the risk. But when lenders pull back, who do you think feels it first? The very buyer who needs flexibility. The approvals that were yes last year become will need more this year. And the market doesn't need every approval to vanish to feel tight. It only needs the marginal ones to hesitate. That hesitation costs deals. There's a human side to all of this that never trends. A buyer sits in a finance office and hears a number they didn't budget for. A manager glances at days' supply and decides to wholesale 3 units they loved yesterday. A lender tweaks a policy by 0.5%, and a ripple becomes a small wave. You won't find those stories in a press release. You'll find them in quiet phone calls, awkward pauses, and let me see what I can do. And if you listen closely, you'll hear the same word under a dozen different phrases: pressure. So does this mean the market collapsed? No. Markets rarely announce collapses. They tighten, they grind, they teach bad habits a lesson, and ask good operators to prove they're as good as they say. The dramatic chart is loud, but the slow squeeze is the real story. It's the reason a family who could buy anytime suddenly waits. It's the reason a dealer who could hold out suddenly sells. It's the reason a lender who could approve on Monday wants more documents by Friday. And that's exactly why this moment is so strange. Everyone's still moving, but more carefully than before. But there's an angle here hardly anyone is talking about. The market is splitting. On one side, buyers who rely on fragile financing. On the other, buyers who bring cash or outside approvals. The first group sees gates closing. The second group quietly gains leverage. If you can show up with money that doesn't need permission, you're not just a buyer. You're solving someone else's problem. You're giving a dealer the clean exit they crave. You're giving yourself the power to walk if the numbers don't work. Negotiating doesn't have to be theatrical. In a tight market, it can be as simple as, "This is my ceiling. This is how fast I can close." The silence after that sentence is where deals happen. For anyone shopping right now, here's how to stay out of quicksand without turning this into a lecture. Pick a payment you can live with before you pick the car you love. That single decision changes every conversation you'll have at a dealership. Get a pre-approval from a credit union and a bank. You don't have to use them. You just need them to anchor reality. When the in-house offer shows up, compare total cost over the term, not just the monthly. Push for shorter terms even if the payment is a little higher. The you 6 months from now will thank you. And if you're underwater on your current car, stop and breathe. Rolling the gap into another loan feels like progress in the moment. It usually isn't. Give yourself space to bring cash, change segments, or reset expectations. That tiny delay can save you years. This is where buyers with discipline quietly win. Not because prices crash, but because terms improve for the prepared. A few basis points off the APR. A shorter term without sticker shock. A trade-in number that respects reality. None of those make for sensational thumbnails. All of them change your life a little. Move like a pro, and even a weird market becomes navigable. The next part is about timing. Timing still matters. Month-end and quarter-end remain useful pressure points. Not because dealerships are caricatures, but because goals are real and money men count. If you're close on a deal, those windows can tip it your way. Inventory mix matters too. If you can love the car one trim down from your dream, you'll feel the difference every 30 days. Be willing to switch segments if you're forcing a fit. And remember, the most powerful word in tight markets is no. When a deal doesn't respect your ceiling, leave politely. The right numbers appear more often when you're willing to walk. What about sellers? If you run a lot, you already know the drill. Speed matters more than ever. Aging out of units is a silent tax. If your process to appraise, price, and recon is slow, you're paying for every lost day twice. The dealers who will win this stretch aren't the ones with the loudest balloons. They're the ones with clean pipelines, disciplined turns, and the courage to take a smaller bite now rather than bleed for the idea of a bigger bite later. And yes, that sometimes means the side door instead of the front. Pride doesn't pay interest. Lenders, you're the quiet metronome behind all of this. You don't have the luxury of vibes. You have vintages, LGDs, and tapes that tell the truth. This cycle doesn't have to turn into 2008 to feel heavy. A little seepage at the edges, a few months of elevated repos, and remember, your customers are also your future customers. The more human you are with modifications and deferrals, the better your recoveries look when the dust settles. No one gets a trophy for won the quarter, lost the relationship. Now, let's touch the hot stove carefully. The viral claims and the big scary numbers. Rumors suggest a nearly half-off cliff dive in a single session. A this is it moment. The official tape showed a brutal, attention-grabbing drop, but the point isn't to chase thumbnails. The point is to understand the direction of pressure. You didn't need a 47% plunge to know this market was tight. You needed one loud morning to force everybody to admit it. And once they did, the dominoes lined up. Banks, buyers, and backlots, all adjusting, all at once. The result? Less swagger, more math. Let's also talk about the 3 paths from here. Not predictions, just maps. Path 1 is a soft landing. Rates edge down, approvals thaw, and new car incentives quietly reappear. Used values cool instead of crack. In that world, you'll see payments become manageable faster than prices become dirt cheap. Path 2 is the grind. Repos stay elevated, negative equity lingers, and everyone adapts to a new normal, where affordable means less car, shorter term, more homework. Path 3 is the hard reset. Something breaks, jobs, credit, or confidence, and the market clears fast and painful. Discounts show up, but so do tighter approvals and more conservative underwriting. Each path rewards the same behavior: patience, math, and the courage to say no until the deal respects your plan. There's one more angle buyers don't consider: your exit. Before you buy, picture how you'd sell. Which trims hold better? Which powertrains make buyers nervous 3 years from now? Which colors are liquid in your region? No, you don't need a crystal ball. You need common sense. Buy the car your future buyer will want, not just the one your present self wants. That single mindset shift can mean the difference between a clean trade and a painful rollover next time. Think like a small business owner. Because you are one, your household is the business. If you're in the thick of it right now, payments heavy, value light, don't panic. You have moves. Refinance is one. Even a small APR win helps. Principal-only extra payments are another. Tiny, consistent overpayments add up. Side grade into a cheaper-to-run vehicle if you can exit cleanly. And above all, don't hide from your lender if you stumble. Early, honest conversations lead to options. Late, silent ones lead to tow trucks. No shame in asking for air. Everyone needs it sometimes. For creators shouting collapse, here's a better story. Discipline beats drama. Panic is not a plan. Prepare is a plan. The market punishes hurry and rewards patience. You don't need to time the bottom. You need to refuse the top that's disguised as just sign here. Keep your budget sacred, your terms sane, and your head clear. That's how you win this year. And if you're wondering what to watch from the sidelines, watch behavior. Do approvals broaden or narrow? Do dealers keep selling sideways to bigger aggregators, or does that slow? Do auction prices stabilize, or do they keep wobbling? Do we talk less about rates and more about incentives? Those little signals tell the truth long before a headline does. Markets whisper before they speak. Learn the whisper. Above all, remember the basics. You're not buying a car, you're buying time. Time to get to work, to take the kids to practice, to carry life from A to B. Don't mortgage 5 years of peace for 15 minutes of hype. The perfect car at the wrong terms is the wrong car. The almost perfect car at the right terms is the right decision. That's not flashy, it's freedom. So did CarMax confirm a collapse? Not exactly. It confirmed something quieter and more useful. There's less margin for error in the used car world right now. For buyers, that means be sharper. For dealers, be faster. For lenders, be clearer. It won't make a viral chart, but it helps real people navigate a messy moment without getting crushed. Here's the question to take with you. Is this the moment to wait or the moment to negotiate like a pro? If you've got cash or solid financing, you may have more leverage than it looks. If the numbers feel heavy, patience is also a decision, and sometimes the smartest one. Quick note, this channel is informational only, not personal advice. Use these insights to guide your own research, and talk to a qualified pro if you need help with a specific situation. If this breakdown helped, please like and subscribe. We're on the road to 100 subscribers. Your support helps the channel and our community grow, so we can keep delivering clear, no-drama car market stories. Drop a comment with what you're seeing in your area, and we'll keep the conversation smart and useful. See you in the next video. Take care. Drive safe.